So last episode, we talked about opening your retirement accounts.
Yeah, but once you're in, you're staring at things like stocks versus bonds. You don't actually know what they really mean.
Yeah, and today we're going to be breaking down the differences between the stocks and the bonds.
Yeah, let's go ahead and dive in.
Let's go.
Hey, welcome back to the Buy Your Kids a House podcast series. Again, I'm Matt. This is Andrew, and this is our deep dive section where we go into the different concepts that go into the book Buy Your Kids a House. And in last week's deep dive, we went into the different types of retirement accounts, whether it's your 401k, your traditional IRA, your Roth IRA. But those are just kind of the concepts of what you can invest into. We're going to go to what you actually can put into those types of accounts.
Yeah, and those accounts are really just the container.
Yeah, and basically by containers, we're talking about you can invest in whatever you want into, whether it's real estate, gold and silver, but also a lot of times when people hear it, they think of stocks and bonds. And a lot of times they hear stocks and bonds, they don't know what the difference of those are. We're going to kind of help clarify that for you.
Yeah, and one of the problems is most people are told what to own, but never explained why.
Yeah, so let's go ahead and break that down. So first off, we're going to kind of dive into what stocks actually are. And a lot of times when people see stocks, they think they're just buying like the little ticker symbol on there, like, okay, I own a little bit of whatever, company then and everything, but you don't realize you actually are owning a piece of that company. Meaning you're have some ownership rights. There's even some voting rights that usually even come into play. You help pick out things on their board. Now, obviously, your voting rights are in proportion to the percentage you own. So for most of us, we're talking a fraction of a percent and everything, but it is still owning a piece of that company. But with that, you're also going to have the option of how the stock actually performs with the company. If it grows, gains interest, gains new contracts and everything, and that's where again the possibility of growth and everything comes from the stock.
Yeah, and that's the upside, because when the company grows, your stocks grow too. So looking at that over long period of time of growth, it's going to go up and down, obviously, but that is such a huge upside to it.
Yeah. But with that, you also have the option of it definitely being more volatile and everything. Like I'm sure most of us remember the crash in 2008. Obviously, it's, the big stock market crash, back in the 1920s. Like there's been several crashes and booms throughout the year, the decades and everything. And that's where, that volatility comes into play and everything. And then that's where the risk of stocks come in. So while you can have the biggest boom, whether you find the next, tech giant or, next, internet wonder and everything, it also comes with the possibility that the entire market could take a little correction or a crash and everything, and then you could lose a whole bunch really, really quickly.
Yeah, then that's, tying into that a little bit, like the short-term investments in stocks and stuff like that are a lot more risky because of those reasons, but long-term investing in the stocks is where you're really going to see that wealth build.
Yeah. So again, that short-term aspect, and we're not trying to find, again, the next internet gem and everything, but the idea is we want that long-term growth, and long-term, so far, historically speaking, stocks have outperformed bonds and everything. So you kind of take the risk with the reward and everything. And so for time being, it does appear that stocks have that better reward over the long term and everything, even if you have those little hiccups like you did in 2008.
Yeah, and I mean, one of the keys is to not panic as well when you see it go up and down, but stay in it for the long haul.
Well, and again, that's also like you hear terms like buy the dip and things like that. So like if we're consistently putting money in each month and everything, when things do drop down, maybe not say the whole boom in 2008, but even these smaller dips you see along the way, if you're buying when the stock's down, that you'll hear other people say the term, the stock's on discount, because they know that the price should and will probably come back up, and you're now getting it at a cheaper price. So long term, that actually can be beneficial into how you're taking advantage of when these little market corrections happen. Now, there are times when stocks are over-evaluated and everything, and sometimes it's done illegally and everything, or even sometimes it becomes an internet meme. We all know GameStop a few years ago,
What a time.
Yeah, to the moon. We're holding, Iron Fist, we're going to hold on to this. But at the end of the day, GameStop was never worth that much money.
Yep.
It just became like an internet pump and dump, which is a legal thing to do, but people found a loophole because it's hard to have a pump and dump when people are just making online threads on Reddit and everything. So... and even like people like Elon Musk get in trouble and everything when he tweets on there, like, buy this or do that and everything. And then people all put their money into it. And then the big whales and everything take their money out. Like that's, not the way to invest in stocks long term. And again, another company, and then we're not recommending necessarily specifically to buy specific companies, but I'm just using examples of what to look forward to and everything. But one of them might be a company like how NVIDIA has been a little bit of an internet darling lately because they're one of the forefronts of computer processing and the chips and everything that they develop. And as the growth of AI and data centers and everything grow, like they're a company you might look at like, I see the potential for them to grow. So I want a piece of that now in the hopes that they will grow in that aspect. Yeah. Now, conversely, if you were back in the early 2000s and you thought, oh, there's this great company called Blockbuster. and you know, like, oh, like I really like taking my kids there on Saturday nights and renting a video and everything. So I want a piece of that. And then they didn't pivot and didn't buy Netflix when they had the opportunity to and everything. And they made every mistake along the way. That might be something where, unfortunately, you make that wrong decision. So again, that's where the risk and reward, not just with the the stocks going up and down as a whole market and everything. It could just be individual companies that unfortunately become a little bit of a dinosaur in their own time because they aren't able to pivot or someone comes along with a better product like Netflix, as we mentioned earlier.
Right. No, exactly. So like just looking at the long term versus short term and having a company that you believe in, I think is also important too, because even if they do make some wrong choices along the way, you still believe in what they're selling or what the product is and what they're doing. And that helps take the sting away just slightly.
Yeah. And that's also where you hear a lot of times also like diversification because, you know, as I mentioned, NVIDIA, I'm not saying put all your money into that one stock.
Right.
Even in the other episode you saw where we talked about the different methods of doing things, you know, whether it is an index fund that has it in a bunch of different companies or even the Magnificent Seven where it has in 7 companies, you know, or even more than that, you're not putting it all into just one because if that one goes bad, you've got no money.
Then you're done there.
Yeah. But, so I think that kind of breaks down what a stock is and, you know, the potential reward from it, but also definitely the risk aspect of it.
All right. Let's look at some of the bond stuff too.
Yeah,
let's dive into that.
Absolutely.
All right. So let's now talk about what bonds actually do. The bonds are opposite of stocks. You're not owning the business, but you're buying the debt.
Yeah. So you're basically saying like, you know, hey, here's my money up front now. And you just pay it back to me with interest. Now, sometimes maybe wonder why, you know, companies or businesses or municipalities might do that. You got to think about it. Like if a company, like let's say Disney, for instance, is wanting to build a new theme park, they don't, you know, as a company, they don't want to just take a whole bunch of money and just build a theme park. It's a lot better to have, you know, people buy a bond from them, raise that money from a debt aspect and everything, and then build a theme park, and then they're not taking a hit on their stock side of things. A city might do that if they're building a new stadium for like a football team or anything, because again, the city doesn't want to come out all that money to build a stadium. They'll take out bonds in the area and everything. They'll help set that up. You know, larger governments might do it for like water treatment facilities, or maybe having to expand something in the national parks and everything. But again, the idea is they're not coming out with all this money out front because also it looks like all of our cash reserves dwindled. They're having the aspect of it like, hey, you give us the money to do this and we'll pay it back to you with interest because, you know, Disney knows when they open a new theme park, they're going to make a lot more money on that theme park. So again, paying a little bit of interest on that bond isn't going to hurt them once they're raking in the money from people buying the tickets go there.
No, exactly. And having that predictability is the point of a bond. It's not supposed to be exciting like stocks. You know how like you can get caught up seeing it go up and then the depression of it going down and then get really excited when it goes up and stuff. It's not supposed to be exciting like that. It's supposed to have that predictability to it.
Yeah, so in essence, for most times you go into it knowing what your rate of return will be and everything. Now, again, that rate of return kind of is inverse to the risk of what you take from that. And what I mean by that is, you know, the higher the returns, the probably more risky the company or something you're taking the loan from buying that debt. So a lot of times you'll see the biggest risk will be something maybe you've seen on Kickstarter. You'll see these companies on there like, hey, you know, help buy my trinket that I made on there. And we'll give it to you at a discount because we're trying to launch this company and everything. But how many times do you hear the horror stories of like, well, I gave them $1,000 for this and I never saw or heard from them again because they never actually got started. So you have that aspect, you know, or you may have like a larger company, like as I mentioned, Disney earlier, a company that's been established for a while. You might still get a decent return on that money but you're expecting Disney to still stick around. But there is still a risk of, you know, even if something like Disney shutting down. Then you kind of go into difference of government bonds and everything. Now you have your municipal bonds, which I hinted at earlier about the idea of building a stadium, or maybe even at the state level, and then, you know, as at the federal level. But the higher up that ladder you go, the less of a return you're going to get. But you're under the guise of the aspect of you're pretty sure that the United States government is going to go bankrupt these days. I mean, fingers crossed.
We're hoping that's not going to be
We're
the
hoping,
case.
You know. So, but again, the higher up the ladder goes, the less of a return you're going to get. But you know, the idea is maybe at the lower level, maybe you get like a 6 or 8% of return. But again, you're having that risk of like you don't know if that company's going to be here. Or at the federal level, it might even just be a 2 or 3% rate of return. You know, some of which I'm sure, you know, a lot of them, especially us older people, got as kids was the good old savings bonds from you know, grandma would give you that savings bond and like, hey, in 20 years you can turn this in for $50. Like,
yeah, you're like, yay, thanks, grandma.
That's what it was. A bond at the federal level, which had a very, very small, low rate of return. But at maturity, then you would be able to turn that in for a certain amount of money. With the idea that Uncle Sam and the national government still be here.
No, exactly.
So, again, that's, you're doing it because you want that predictable rate of return without the potential, because, if the stock market crashes, that doesn't impact the bond market.
Right. No, exactly. So that stays a lot more consistent. Like we were talking about the predictability of it for sure.
Yeah.
And then we're not using it to get rich. A lot of people use stocks to get rich over bonds for sure. Bonds are just there to help keep your wealth going.
Yeah. And again, like I'm sure many people right now are looking at like, well, you mentioned 2 or 3% rate of return. Like, why the heck would I invest in something with such a low rate of return compared to a stock that, may boom overnight or even consistently, get 10, 15, 20% of rate of return? Why the heck would I choose that 2 or 3% over the 10, 15, or 20%? Or even just your consistent 10% or so every year? Like, why would I exchange those different rates?
Right.
And that's where kind of your age and everything comes into play. Where the risk versus reward comes in and everything. And I think we're going to kind of break down at what age should you be looking at these, and where maybe they're a better fit for you at your investment journey.
Yeah, all right.
Yeah.
So that kind of covers the bonds and stocks and just the very basics of what each are. We haven't gone deep into either of them because there's a lot more to it for sure. But like you said, the age has a lot to do with it. So I think we're going to talk about that next.
Absolutely. Okay, so now that we kind of cover the different aspects of stocks and bonds and everything, you might be wondering, well, how's this apply to me and everything? And then that's where the difference of your age really comes into play. So whether you're in your 20s investing or in your 50s or 60s investing, that's where the difference of like almost like a seesaw kind of comes into play. The younger you are, the more risk you can absorb, because yes, the 2008 bubble crash was terrible. But if you're in your 20s and you're now, 30s and 40s past that and everything, you still have time to catch up from that. And the market has corrected and grown past that point. But if in 2008 you were already in retirement age and that market takes a big dip, well, now your retirement just disappeared. So you can't absorb a loss like that because you don't have the time for it to catch back up. So then the thought is that in your younger years, you're a little more stock heavy, and then your later years, you're a little more bond heavy with that.
Yeah, and more things contribute to that too, because that's not the only factor in this. You got to take into consideration like stable income, your finances, your emotional like health, and where that's at too. All of those things do contribute to this as well. So you got to look at that when you're going into it as well, looking at the different stocks options and the different bond options as well, making sure that it fits within your budget, also fits in with what you want to accomplish and see long term.
Yeah, absolutely. And like, so again, as you mentioned, if you're already in retirement age, and let's say you have enough to you're making from your investments, let's say $100,000 a year, just make a nice round number. You want to protect against living too long from that. So like $100,000 today in 20 years might seem like 75,000 because of inflation over time.
Right.
So you want to protect against inflation. That's where maybe a bond might come in for that. So inflation is usually 2.5 to 3% a year. Well, if you have a bond that matches that 2.5 to 3% right there, the 100,000 now will still seem like 100,000 in 20 years from now, because you've had a bond to help hedge against that inflation aspect of things.
Okay.
So you still get the same level of comfort of living off of the same time period of actually being through your retirement years from that.
So what we're looking at is using them to complement each other instead of work against each other in that way. Then is what we're looking at. And also, like you said, the age is huge, because if something did go wrong or something offsets the other, you have the time to recover from that.
Yeah. Now, again, I'm not saying that when you're older to not buy or invest in stocks at all. I still definitely like the idea of a growth aspect. But you might have more like maybe a 60-40 split, like 60% in bonds, 40% in stocks, something along those lines, where you have that balance. So you can still have the growth and maybe even grow beyond, maybe leaving more of a legacy to your family and everything afterwards. But if something wasn't happy, you saw that steady bond return and everything to help hedge against that volatility. Whereas if you're younger, you might only have maybe 5 or 10% in bonds and your other 90-95% in stocks, because you can ride that roller coaster ride a lot longer.
Right. And I mean, since we're talking about the age and everything like that, like we had mentioned already, like having that time is a huge contributor to that, because we're not talking about getting rich quick. We're talking about the longevity of it too, and like what's going to create that generational wealth, instead of, something like maybe day trading, which I still like that. I could never, I don't think I could ever get into it. I know a lot of people that's their slot machine.
Yeah.
They're, like in and out constantly. Like we work with someone that likes to do day trades all the time, and some success, some not, but that's immediate.
Yeah.
We're not looking at like the instant gratification of like getting a little bit of money here and there, or that instant wealth. It's over time.
Absolutely. And again, I'm not trying to knock if you like day trading, especially if it's a hobby. But if you're
Yeah.
putting all your money into day trading, then that can get a little too scary. I very much remember back when COVID happened and everything. A lot of us were furloughed or lost our jobs entirely and things on those lines. And I had people contacting me like, "Hey, Matt, how do I replace our income with the day trading aspect? Where should I invest in?" And they're talking about having $1,000 and trying to make $1,000 a day. I'm like that. It's just not going to happen that way. In order to make $1,000, you need $1 million. You need a lot more money to make that little bit. And even from there, it's definitely still risky and everything. And so the person unfortunately got a little upset with that. The idea of investing just a little bit to get that quick return. It just doesn't work that way. Otherwise, a lot more people would be rich.
Yeah.
And again, if you like day trading and it's fun to look at the knowledge. You're on there. You're looking at the different reports and quarterly statements and everything. That can be very interesting to some people, and you have fun enjoying that. Sure, but I definitely recommend reading a book called A Random Walk Down Wall Street, and it basically goes over from the dawn of the stock market all the way now, all the ebbs and flows over time, and it basically shows just investing in a normal index fund outperforms all the gurus that have ever had those short-term gains, and might have had the oil booms in the 70s and 80s and everything, the tech boom in the early 2000s. Those booms were great, quick high, but then it quickly levels off.
Yeah.
And again, we can never predict the future, but we can look backwards, and that's where even just a simple index fund in the Fortune 500 companies usually produces around 11% rate of return over the past 40 years. And that includes the fall in 2008 and the fall after September 11th of 2001. So I mean, we're talking over those time periods, you've had two big dips, and it's still averaged 11.5% over that time frame. And that that volatility and everything still outperforms what a bond would do and everything. But again, the idea of quick day trading just isn't there.
Yeah, we need to start moving out of that idea of quick gratification, of that quick money, to be able to set up the long term, like everything that this is about. Setting up the generational wealth, buying your kids a house. Like having that goal. And like you were saying, there's nothing wrong if you enjoy it and you have that little bit of extra money to put toward that on the side, and you like going up and down. That's awesome. Like, and it's your entertainment, if you will. But don't put it all into day trading,
And the thing is with day trading, if you're doing it based off just watching the little tracker numbers on there and everything, it's a video game. Yes, you may get lucky every now and again, but it doesn't have the hard facts of what you're doing there. If you're doing it based off of reports that are coming out, I promise you there are big whales that are getting those reports before you get them. There was an investor that I like to follow online, and he talks about back when he was more so in a Chicago hub of actually like on Wall Street, with the tickers like back in the day. And he talked about that he actually tunneled out and was one of the first ones to put fiber optic cable in his line just so he can get information a few seconds faster than anyone else on the floor, just to give him that little bit of an edge.
Yeah.
And that was someone that eat, sleep, and breathe stocks.
Yeah.
And he's like, none of us have access to that. So again, the idea of like him in the hub in Chicago, with all the whole wall panel of everything going, and he's tunneling it out to get special fiber optic cable just so he can get information that little bit faster.
Yeah.
By the time you're seeing it come across on MSNBC News or CNN or Fox News, whatever money thing you're watching to get the news on and everything from the financial side of things, it's already well known amongst the whales.
I was going to say they've known for a lot longer.
Yeah.
So.
And so again, you're not all of a sudden gonna be like, oh, now I need to buy this thing and then get in, because I promise you all the money's already been put into it, and you're just the icing on the cake. And then if it doesn't turn out, then you've lost some money, or best case scenario, saved the same amount of money and everything.
Right.
So definitely stocks, definitely in our opinion, more so for long term. Buying now, waiting a while. Even when it dips, you're going to keep holding on to it. I think if you do believe still in the company. Now, if you have news come out and you need to sell stock because you hear like a Blockbuster again, coming out like, hey, I see a Netflix coming in and taking too much of that market share, and I realize that Blockbuster isn't the company that meant to be. Absolutely, sell that stock.
Right.
So we're not saying hold on to the bitter end, but don't do if there's a dip just because overall market corrects, don't panic sell.
Yeah.
So,
and then the last thing I wanted to mention as well, since we're talking about age and how that does help benefit you having that time, but it isn't too late to start.
No, absolutely.
You can start at any stage. Just because it gives you an advantage, if these kids, if they start doing it in their teens, 20s, 30s, doesn't mean that, 40s, 50s, 60s, you can't start. You can start anytime and
Absolutely.
still see like improvement from it.
No, absolutely. There is no time better than the present.
Mhm.
And again, and I know we mentioned earlier, if you're older, you may want to go more bond heavy. If you haven't started, you're a little later in the game, you still might want to go stock heavy initially because you definitely want to have that potential for better growth in a more rapid time frame because unfortunately time is against you on that side. So if you're in your 40s, 50s, or even 60s and you're just starting out and everything, it might be worth it still to do stock heavy on that aspect because you're trying to catch up for time. But definitely don't do nothing because inflation's happening no matter what. I know right now we're in an age where inflation is even higher than what it normally is, but even on a normal basis, 2.5% to 3%. If you stuff that money in a mattress, next year that mattress is now 3% less than what it was last year. So doing nothing is not good. And I have coworkers of ours and things that have come to me and they're a little bit older and they're like, hey, I haven't even started doing this. Like, should I even bother? Absolutely.
Yeah.
Putting in for something, even if you're going to gain just a little bit, is better than nothing. So again, yes, you may start to work a little longer into your golden years, and you may have to, but like at least it's earning something on the side and making those golden years at least a little bit offset. Even if you start to work in your retirement part time and everything, like become Walmart greeter or something along those lines. Something you can enjoy in your retirement years to help supplement investing as soon as you can, whether that's in your 40s, 50s, or 60s, is still better than not doing anything at all.
No, exactly. And I think that kind of covers the basics for this as well, having that age work for you or like what to look at if you're starting a little bit later, like you just, let us all know the best option in your opinion of how to go about that is super important, I think.
Yeah. So again, no time like the present. If you're listening to this right now and you haven't done it, go ahead and click open an account on whatever brokerage that you want to, and throw something in there. Even if it's $100 or whatever, doing something and start consistently putting that money aside, getting that habit of paying yourself first and everything. Because if you don't start doing that, next thing you know, it'll be next year. Next thing you know, it'll be the year after, and then all of a sudden you blink an eye, and all of a sudden your kids are growing up, you're in retirement age, and you're like, I did nothing.
Yeah, no, it can sneak up on you real fast for sure.
I remember this wasn't great.
I was gonna say we're both still relatively young, and I still got a lot of grays down too.
You may are young. I don't feel young anymore.
Well, that's I think a different episode.
Yeah. Okay, but I think that kind of covers again stocks versus bonds versus what your age aspect is and everything. And again, if you have questions on this, please feel free to throw in some comments on this because we're doing general organizations, but if you have a specific to your case, we'd be happy to dive into it of where you're at in your stage in life and what you look at, like, hey, like what mix of it that I should look at. Should I go look at 80-20 split? Should I go 70-30? What are we looking at today? We'll cover that. We'll try to help you out in that specific aspect of what we feel where that fits in with your age and your life situation and everything. So
yeah, absolutely. All right, well, on to the next.
Yeah, so we'll kind of cover in how that fits into the whole model of what we're looking at, and then we'll wrap things up.
All right.
Yeah. Okay, so I guess now we're going to kind of pull it all together how it fits into the buy your kids a house model and everything. And in essence, if we haven't gathered so far, we're talking about in your early years, prioritize growth, and in your later years, may want to have that more stability to make sure your income's protected in that aspect.
Yeah, and bonds are a tool. They're not necessarily a requirement. They're there for us to use.
Yeah, and like understanding the difference and how it impacts you and impacts your finances is really what it boils down to. What matters in this aspect, not necessarily what stocks or what bonds. Again, it's just kind of the idea of what you need to use for the time frame you're at and what your priority is, whether it's growth or the income stability.
No, exactly. And also, it is important to know what's inside your retirement account. So that is kind of like a homework, if you will. Look into that and see what you have in there in that account.
Yeah, and some people are like, "Oh, what do you mean you're giving me homework on this?" I didn't know I was going to do research on this.
I've been out of school for 45 years.
I'm done. I'm done with the homework. I don't need to take any tests. A lot of times you'll have people, and I have people come to me a lot of times with 401ks, not even knowing what they've invested in because it's just what their employer gave them, and they're just told like, "Hey, sign up for your 401k, invest this. That's what it's done." Well, look into actually seeing what they're actually investing in. A lot of times they're age banded, so they'll give a predetermined mix based off your current age of stocks versus bonds. And a lot of times you'll see it'd be like, investment account retirement age, 2045, meaning that the company is expecting you to maybe retire in the year 2045. So based off that age frame, it'll give you that predetermined mix of stocks and bonds. Well, maybe you decide, well, maybe I'm willing to take a little more risk. So you might turn it into a retirement account 2065.
Yeah.
Because then the later you retire on, odds are that account will have a more stock heavy focus in that mix versus bonds. Or conversely, let's say, you're like, hey, like I've already got a pretty good amount there. I'm happy. You might tone it down and make it more bond heavy. But you can play around with it in there. But now you can actually look into that 401 account and actually know what that mix and everything is looking like, and how that impacts you. And a lot of times you might just blindly click and just invest. See what your money's actually doing in there.
Well, no, exactly. And that is important to be able to see where your money is going and how it's doing because of such the fluctuation that we have constantly. I think it's important to have that knowledge to be able to stay on top of all of it.
Yeah, absolutely. And again, I might be a little more willing to take risk and everything. So I know, for instance, my wife's 401k, I've fudged it where it appears like that we're more stock heavy on hers and everything, because again, I'm willing to take that risk and everything, knowing that in the long term that these funds and everything do bounce back, and I still feel we have a long enough of our lifespan ahead of us that we can handle if there's another dip and everything along those lines. Now I'm not saying for you to go do that. I'm just saying that that's how my situation where I did it with hers, but not knowing is not good. So please go in there and look and see what it is and what you can do, and then to see if there's something you want to tweak or change with that, and then see how the performance of it has been over the years. Because again, you might be surprised at what you find and everything there.
Yeah, and it's a lot more of an individual thing too, because like we were talking about, taking into consideration where you're at in your life, your emotions, things like that, it becomes a lot more of an individual than just like a mass. And so having that knowledge to be able to tailor it to yourself is super important. And we want to know where you're at with it too. Like, comment, subscribe. We want to hear like what you've invested in. If you're just doing your 401k blindly and you're like, oh, maybe I should find out how much is in there, where it's going, what was my money doing for me, and to take a step back and look at the bigger picture instead of just pushing it off to the side and just letting it sit. We still let it sit, but having that knowledge is a huge tool for sure.
Yeah, and again, put it on there if you were shocked and surprised by something that was revealing to you in this and everything, because I've had people that when they looked at their 401ks and they'll yell at me saying, oh, investing in the stock market is terrible. I've been putting my money in 401k for years and it's only gotten me 4 or 5%. And then we've looked at it and saw that it was very bond heavy. I'm like, well, you actually have been investing in stocks. It's been bonds and everything. So again, that's what they realize and adjust it to what have more potential for growth and everything. So again, look at it, see, tell us if there's something that was revealing. Again, we're still a new and up and coming show at this. Help us out, like, share, subscribe. In the next episode, we're going to be kind of going over a little bit of also having the travel loyalty. That again, you want to invest hard, to play hard. We want to have the idea of having that loyalty going to the companies to then maybe they reward you in the aspect of free nights at hotels or perks or upgrades, and how to work with that, because again, we're not just trying to invest and die with Scrooge McDuck with all of our money. We want to enjoy the money, and traveling to me is a big part of that. So.
Oh no, absolutely. Experiences is huge.
Yeah. So please join us on this journey, and let's all build to a great retirement together in this process.
Till next time.